The Iran conflict just sent shockwaves through global markets. Oil jumped from around $65 to over $100 in just 2 weeks. Headlines are screaming panic, markets are volatile. Investors are scared. But here's the reality most people miss. Moments of maximum fear are often the biggest opportunities. Today on Future Finance Lab, I'm breaking down how smart investors position themselves during geopolitical crises and what history tells us about markets during wars. Part 1. The Market Panic Cycle, 0.25 to 120. Whenever a major geopolitical event happens, the market usually follows the same psychological cycle. First comes fear. Investors dump stocks. Media headlines predict economic collapse. Retail traders panic. But historically, something very different happens. Markets usually experience a short-term dip, often lasting around 30 to 40 days. After that, they begin to stabilize and eventually recover. If you look at the last few decades, wars in the Middle East, the Gulf War, Iraq, Ukraine, the pattern is surprisingly consistent. Short-term volatility, long-term recovery. The S&P 500 has grown more than 10x over the last 30 years, despite dozens of global conflicts. The lesson? Markets price fear quickly, but they also recover faster than people expect. Part 2. Why oil is the key factor, 120 to 240. Right now, the biggest variable driving market sentiment is oil prices. And that's because of one critical location, the Strait of Hormuz. This narrow passage handles roughly 20% of the world's oil shipments. Any disruption there creates instant uncertainty in global energy markets. That uncertainty is exactly why oil prices spike during Middle East conflicts. But here's something important many people forget. Historically, oil spikes caused by wars are usually temporary. Let's look at a few examples. Gulf War 1990. Oil doubled, then returned to normal within a year. Iraq War 2003. Oil surged short-term, then dropped again within months. Russia-Ukraine War 2022. Oil hit around $130, then eventually settled back near pre-war levels. Markets tend to overreact to supply fears, especially in the early stages of a conflict. Part 3. The real risk. Stagflation, 240 to 340. Right now, investors are worried about something called stagflation. That S when two bad things happen at the same time. High inflation, weak economic growth, oil spikes increase inflation pressure. Weak job numbers slow economic growth. That puts central banks in a difficult position. Normally, if the economy slows, the Federal Reserve might cut interest rates to stimulate growth. But when oil prices push inflation higher, cutting rates becomes much harder. This uncertainty is what's creating volatility in the markets right now. Part 4. How long-term investors think, 340 to 440. Professional investors don't usually react to headlines. Instead, they focus on long-term positioning. Historically, many successful investors use market volatility to gradually build positions in strong companies or broad index funds. One strategy often used is dollar-cost averaging. Instead of trying to perfectly time the market, investors buy consistently during downturns and recoveries. Over long time periods, this approach has historically helped investors benefit from market growth while reducing timing risk. The key mindset shift is simple. Volatility isn't always a threat. Sometimes it's an opportunity. Conclusion, 4:40 to 5 o'clock. Geopolitical events will always create fear in financial markets. But history shows that markets have a remarkable ability to adapt and recover. Understanding the bigger picture, instead of reacting emotionally, is one of the most powerful advantages an investor can have. If you want to learn how global events shape markets and how investors think during crises, subscribe to Future Finance Lab. Because in finance, knowledge isn't just power. It's strategy.